Good evening, everybody. Thanks for joining us. This week, I want to talk about a technical indicator that's available to you on the Plus500 charting system, and that's the Relative Strength Index, or the RSI. And the RSI is basically a momentum-based indicator. It highlights similar sort of activity as we do with some of the other momentum-based indicators like slow stochastics, for instance, that we've looked at previously. And the RSI, basically, the way it's calculated, I won't go into the exact formula of the calculation, but basically it takes the average number of up moves, or the extent of the up moves over X periods, against the average number of down movements over that same X period. Now, the default setting on the Plus500 system is 14 periods, but I've shortened this to 9 periods. And this basically allows me to see slightly quicker signals. There's less smoothing factor within the calculation, and it just means that we can get some earlier signals and turning points potentially within the markets themselves as we run the indicator. Now, it's a single line indicator that ranges between 0 and 100. Now, because of the calculation, it's very rare that we see these extremes hit. And the traditional use of the RSI is to highlight overbought readings when it's above 70 and oversold readings when it's below 30. And when we start to see a turning point, so if we hit an overbought level of above 70, and then the RSI moves back below the 70 level, it suggests that the market is correcting against overbought readings with the risk of a more extended downside move. On the flip side, if the indicator breaks below 30 to highlight an oversold reading, we're then looking for the indicator to break back above the 30 line to suggest that the oversold readings are having influence on trader activity and that we're starting to see short covering and an unwinding of these oversold readings. Now, a problem with the RSI and any momentum-based indicators we've touched on over previous weeks is that quite a bit depends on the trending condition of the market. And we know that overbought and oversold readings will be ignored when we're seeing aggressive up or down trending signals. So in other words, if the market's rallying sharply and you see the RSI above 70, it won't necessarily mean that we're hitting overbought readings. So basically, it can stay overbought, even give slightly false signals that we'll look at in a second. And the market will continue to move because we're still looking at positive trending conditions and positive sentiment indicators. So in that setup, the market will ignore the overbought readings and continue to see price strength, and the same with a downtrend. Okay, so let's take a look at a daily chart of the UK 100 index and the 9-period RSI, which is the line below the price action. And I've highlighted by the circles areas which reflect overbought, marked by the red circles, and oversold, marked by the green circles. Now, you'll notice that price action is caught within a sideways trading range. So in other words, we're seeing very choppy activity between the support of the recent lows and resistance offered by the recent highs. So something of a battle is going on between the bulls and bears until we start to see a breakout. But this is when the RSI in particular is most useful for highlighting overbought and oversold readings. So when we're not in an aggressive trend, we're in a more balanced sideways activity, then we should take more notice of the overbought and oversold readings. And as we'll see, they can highlight some quite interesting turning points as we approach the resistance levels, the previous highs, or the supports offered by the previous lows. And when we start to see the indicator turning, say, for instance, below the 70 level, having hit an overbought reading, that can reflect a corrective phase within this broad sideways trading activity until we start to hit oversold readings below 30, and then the indicator rallies back and breaks above that level to reflect that the market has hit an oversold reading, against a support point, and the risk is that things are beginning to turn back towards the upside to extend this broad sideways activity until we start to see a breakout occur. Now, if we look at a weekly chart of the US 500 index, again with a 9-period RSI, so a 9-weekly RSI, we can see that the sell-off from the March 2020 highs into the February 2020 highs into the March 2020 lows, we can see that the overbought and oversold readings reacted reasonably well in highlighting those turning points. Again, using the process that even though the market was very overbought within this setup, once we started to see the break back below the 70 level, in both cases, the market then started to see more significant correction phases. Now, we also saw a divergence within this period of activity. That's where the latest price highs weren't confirmed by new upside extremes within the RSI. So this added weight to the cross back below the 70 level, having seen this second peak not confirm within the RSI indicator. So we saw what's called a bearish divergence, new highs in price not confirmed by the indicator, and then a new turn lower. So within this environment, the RSI worked well in highlighting both overbought and oversold readings, because as we can see from the March 2020 lows, having hit this oversold level, the market extended and rallied very strongly. However, we can see that the market is trading within a more aggressive uptrending condition, bullish sentiment, prices making higher highs and higher lows. And this is where momentum-based, and particularly the RSI indicator, is vulnerable to giving false signals. Because we'll see within this more aggressive trending condition, when the indicator hit overbought levels and then broke back below the 70 level, we saw consistent false signals, very short-term corrective phases, and then the market continuing to move higher and extending the bullish pattern. So in other words, these corrective phases didn't see us back towards oversold readings. So we need to be aware that within aggressive uptrend or downtrending signals, we need to actually move the oversold level higher or lower, depending on the direction of the trend, to reflect the potential turning points within this longer term bullish trending condition. Now, if we look at the daily chart during this period for the US 500 index, we can actually see that from a daily perspective, the RSI did work reasonably well in highlighting oversold conditions. Because it's a daily chart, we're looking at shorter base signals, and that the indicator is more volatile in highlighting these correction phases to the oversold levels. So again, reflected by the green circles, we can see where oversold levels have been hit within the indicator. The indicator then crosses higher back above the 30 area to reflect oversold levels turning positive within a bullish trend. So the way I would tend to use the RSI is within this type of environment is if we start to see oversold readings being hit within a bullish trend, then that can be a very strong signal of a turning point within that positive trend and the risk to extend the bullish pattern of higher highs and higher lows. So an oversold reading within the bullish trending condition is a very strong signal, especially if the RSI then starts to break back above its 30 line to reflect a resumption of the positive trending conditions that have dominated for so long. So the RSI can be useful within an uptrend, but we need to know its limitations, and we need to know the types of signals that we're actually looking for within this environment. Certainly within an aggressive bullish trend like this, I would ignore all overbought signals because they effectively just create a very short-term correction. And unless we suddenly start to see a more extended sell-off to the oversold readings, which are more significant, then correction from overbought levels can be limited before the market then rallies further and makes new highs. So if we were to look at the current chart of the US Tech 100 index, together again with a 9-period RSI, we'll see that we're in one of these environments where the market is trading against oversold levels and is failing to really reflect significant turning points. So we can surmise that we're trading within a bearish trend, and even though the market is hitting traditional oversold levels, the fact that we're still seeing aggressive downtrending conditions, sentiment is still more bearish, and upside is limited within that environment to highlight an extension of this ongoing bearish trend. So we need to be aware of overbought levels being much lower than the 70 within that area. So it may even be 50, it may even be 40 if it becomes an aggressive downtrend. And we need to ignore the oversold readings in this type of environment, because we know within a bearish aggressive downtrend, as equity markets seem to be trading in at the moment, we're looking more for more aggressive sentiment dominating the market, and effectively traders ignoring oversold conditions, having already seen aggressive and prolonged declines.